All right, in this video, we're going to take a look at notes payable. We've done something like this before, so this is pretty much just a refresher on how to account for the issuance of a note and eventually paying that back. So here we have an example. It says on November 1st, Porter Company borrows $10,000 from its bank for a period of 6 months at an annual interest rate of 6%. Interest expense, adjusting entries made at year end. So in this case, anything involving interest, they don't do adjusting entries for that until the end of the year. All right, so on November 1st, if we count 6 months later, not only are they going to have to pay the $10,000 note back, but they're also going to have to pay back the interest that would have been accrued. So what would be 6 months worth of interest? Well, we need to take the principal amount of the loan, multiply it by our interest rate of 6%, and this would be for an entire year, right? So let's find out a whole year's worth of interest. We'll take $10,000 times 6%, that's $600. Well, that's for a full year, so we're going to take that $600 and divide it by 2 to find out what interest would be for 6 months. So that's $300 of interest for 6 months. All right, so how would we account for this first off? So on November 1st, what happens on November 1st? Well, we borrow the money, right? So we need to do an adjusting entry for borrowing that money. So we are going to debit cash for the amount of cash received. We're going to debit cash for $10,000, and we are going to credit notes payable for $10,000. So that's just receiving the money that we borrowed now from the bank. Now, when are we going to have to pay this back? So it's 6 months, right? So it's November, December, January, February, March, and April. So the beginning of May is when all of this will have to be paid back plus interest. But the thing is, November 1st is pretty close to the end of the year. By the time December 31st rolls around, we're going to have to do an adjusting entry for interest expense accrued. So how many months would have passed from November 1st to December 31st? So that's 2 months, right? So we have to record 2 months of accrued interest. 2 months of accrued interest. Well, we already found up above what 6 months worth of interest is, right? That's $300. Well, if we divide that by 6, we can find out what the monthly interest is. So we'll take $300 divided by 6 months. So that's $50 of interest per month. Well, if 2 months of interest would have accrued that we would be owing as of December 31st, we just take the $50, multiply that by 2, and that's $100 of interest that would have accrued. So how are we going to record that? Well, we're going to debit interest expense because although we haven't paid it yet, it's still expense because we owe it, right? Once the clock starts ticking on something like a loan, the interest starts building up. So we're going to debit interest expense for $100, and we are going to credit interest payable for $100 as well. And that interest will eventually be paid at the end of the 6 months. All right. Now, what about on May 1st when we actually pay back the note? When the note is paid back. And again, remember, plus interest. Well, there's a couple things going on here on May 1st. Well, we're paying back the $10,000 of the note, yes. We're paying $300 of interest overall, right, for 6 months. But $100 of it had accrued for last year. 2 months of it was accrued over the last 2 months of the previous year. So we're going to pay off $100 of this interest payable, and then we would have to record the interest expense that would have been incurred for the other 4 months of going into this next year. So we're going to debit that interest payable up above because we're paying everything off now on the payment date. We're going to debit the interest payable for $100. But now we have to debit interest expense as well, but for because remember, we've gone into a new year and there's 4 months of interest expense that still needs to be recorded. So that's $50 per month. $50 times 4, that's $200. So we're going to debit interest expense of $200 here. And we're going to debit the note. We're going to debit notes payable for $10,000. We will credit cash here for $10,300. So by looking at this, we can see that there's $300 of interest that was paid, like we had determined at the beginning. But remember, this note spanned 2 years. It's a 6-month note, but it didn't originate until the end of last year. So $100 of that $300 was recorded as interest expense in year 1, and the other $200 of the $300 of interest that would be paid, the other $200 was recorded as interest expense in year 2. So that's what happens. You have to be careful when recording this if a note spans more than 1 year. And then we remove that note. So all in all, the cash that needs to be paid on the maturity date is $10,300. All right, so keep watching on to the next video where we're going to look at an installment notes payable.